For many people, credit scores are this mysterious entity out there that people don't necessarily understand all that well. You need a good credit score in order to get loans for cars and mortgages. But what exactly is a good credit score and how do I get one? Let's take it one step at a time and look at exactly what goes into a credit score. Hi, I'm George Poporad with eXp Realty, and today we are talking about what goes into a credit score. Credit, or FICO scores, are calculated using many different pieces of data from your credit report. The data is grouped into 5 categories: credit mix, new credit, length of credit history, amounts owed, and payment history. 10% of your score is based on credit mix. Now this refers to the types of accounts that show up on your credit report. Even though it makes up a small portion of your score, diversity will help you here. FICO scores will consider your mix of credit cards, retail accounts, installment loans, financial company accounts, and mortgage loans. Now don't worry, it's not necessary to have one of each in order to have a good score. Another 10% of your FICO score comes from the new credit category on your credit report. In general, people who open many new credit accounts within a short period of time are seen as riskier borrowers. Too many applications for new credit can mean that you're taking on too much debt or that you're in some kind of financial trouble. So always try and limit the number of new credit applications. 15% of your FICO score comes from length of credit history. In general, having a longer credit history is favorable because it gives more information about your spending habits. A longer history of reliable borrowing will mean that your score will be higher. Keeping accounts open for a longer time will lead to a higher credit score. However, you can have a high credit score if you are a new borrower. 30% of your FICO score is based on amounts owed. The amount of debt you have in comparison to your credit limits is known as credit utilization. The more money you already owe, the less flexible your spending is, which makes it riskier for you to take on new debt, which can lower your credit score. Having credit accounts and owing money on them does not necessarily mean you are a high-risk borrower with a low credit score. However, if you are using a lot of your available credit, this may indicate that you are overextended. And banks can interpret this to mean that you are at a higher risk of defaulting on your loans. Now, the highest weighted factor when it comes to your FICO score is payment history. The first thing any lender wants to know is whether you've paid past credit accounts on time. This helps the lender figure out the amount of risk it will take on when extending you credit. Lenders are most concerned about whether or not you pay your bills on time. So the best indicator of this is whether you've paid your bills in the past. Late payments, debt collections, and bankruptcies all affect the payment history portion of your credit report. The better history of paying your debts on time, the higher the credit score. So now you know the 5 factors that go into a credit score. Don't you feel smarter now? If you are thinking about buying or selling a home here in the Cleveland area, or you just have some real estate or home related questions, reach out, let's have a conversation. Thanks for watching.